All right, let's talk about fintech. Because for years, it's felt like a massive party where the music would never stop. But that era of easy money and deals that seemed almost too good to be true, it's coming to a screeching halt. Today, we're going to dive into the big reality check that is shaking up the entire industry.
I mean, this quote just nails the feeling, doesn't it? For so long, you had all this venture capital and big bank money fueling a boom where fintechs could just offer these incredible deals to grow at all costs. But here's the thing. At the end of the day, you still have to make more money than you spend. And that basic math is finally reasserting itself, forcing a massive, massive shift.
So, where are we seeing the first cracks appear? Well, it all starts with the very foundation that so much of the fintech world was built on: the big, established banks.
Take Wells Fargo, for example. Their latest earnings report didn't just land badly, it sent actual shockwaves through the market. Investors got really spooked by rising costs and, well, a pretty murky strategy for future growth. And for investors looking for stability, murky is the last word you want to hear. The fallout was immediate, and it dragged down other major players like Citigroup and Bank of America right along with them.
And you can really see it here. This wasn't just a one-off problem. This coordinated dip shows a much broader unease in the market. The very banks that were the powerful engines behind the fintech explosion are now facing their own serious headwinds.
And this really gets to the heart of the change. In the past, banks like Wells Fargo were what you'd call sponsor bank power players. They were happy to subsidize these fintech partnerships just to get a piece of the action. But now, things are different. They're getting squeezed by intense regulatory pressure, and the profit margins on these deals are razor thin. So their appetite for this stuff has cooled off, and I mean fast.
So the bottom line is that the financial safety net that so many of these fintech companies were relying on is, well, it's disappearing. And believe me, those ripple effects go way beyond the boardroom.
In fact, these ripple effects are being felt directly by consumers, by you and me. The products we're being offered are changing, and the rules of the game are being rewritten right before our eyes.
Let's look at a perfect case study: Bilt. You might remember them. They offered a deal that seemed to defy gravity. You could earn valuable credit card points on your rent payments with zero fees. It was so popular that it was reportedly losing its banking partner, Wells Fargo, a ton of money. But now, Bilt is back with a new offer that's turning heads: a credit card with a 10% APR. Just think about that. In a world where 25, even 30% rates are common, that sounds absolutely incredible. It's pure fintech catnip, designed to get everyone talking. But you knew there had to be a catch, right? Here's the pivot from the headline to the reality. That amazing 10% rate, it's an introductory offer. After year one, it can jump to nearly 35%. See what's happening? The flashy headline is a growth hack, but the fine print, that's just classic, old-school credit card math. And for anyone not paying attention, that's going to be a brutal surprise. Bilt's pivot is a perfect example of this larger trend we're seeing everywhere, something we're calling the post-subsidy era. The strategy of just burning through investor cash to get users with deals that make no financial sense, that's over. Now products have to be built on real, profitable math, right from day one. So, in this new post-subsidy era, it's pretty clear not every fintech is going to survive. What happens when a company built for the old world fails? That brings us to our final section, the aftermath, and the rise of the cleanup crew.
Remember Aspiration? They were kind of the Patagonia of finance, the debit card that promised to save the world one tree at a time. It had these peak 2019 vibes, tapping right into that whole conscious consumerism trend. For a minute there, it really felt like the future.
But wow, look how quickly things went south. Those peak vibes of 2019 gave way to a founder's fraud conviction and a bankruptcy in 2023, leaving customers just stuck in limbo. And now, in 2024, we're watching the salvage operation. And this is where the story gets really fascinating. The company picking up the pieces is Coastal Community Bank. And they aren't just any bank, they're a major sponsor bank, the regulated institution that actually holds the money for huge names you've definitely heard of, like Robinhood and Dave. This quote really captures the new dynamic perfectly. This isn't about chasing explosive growth or some exciting acquisition. No, this is a sponsor bank stepping in to manage the fallout, to protect the infrastructure and ensure compliance. It's a cleanup job, plain and simple.
So, the Aspiration story is a cautionary tale, for sure, but it's also a huge signpost pointing to this larger shift. From the wobbling big banks to the fine print in our credit card offers, it is all connected. So let's put it all together. What does this new reality check really mean?
Let's distill this down to 3 key lessons. First, the big bank money printer for fintech growth is officially off. Second, those unbelievable perks we got used to are being replaced by traditional economics, so you have to read the fine print. And third, sponsor banks are evolving from silent partners into the adults in the room, the ones cleaning up the messes.
Ultimately, the era of free and too good to be true in fintech is ending. The industry is being forced to grow up, and it's happening quickly. Now, this probably means more stability in the long run, but perhaps fewer of those revolutionary deals. So the real question is, as this new, more pragmatic reality sets in, are you ready for what comes next for your money?